When most people hear the word diversification, they think it means owning a mix of stocks and bonds and funds and other Wall Street investments. And while that can be part of it, I'm here to tell you that that is not the full story, and believing that could be a costly mistake. True diversification means building a financial foundation that can weather any storm. If you've been relying solely on stocks and bonds to protect your wealth, this is your wake-up call. In this video, I am going to break down why diversification matters so much right now, how it works, and what you can do to make sure that your portfolio is prepared for whatever comes next. My name is Megan Robin, and I am a California tax attorney. In my practice, I work with my clients to create financial plans that make sense from a tax perspective. Let's talk about diversification. True diversification is about not putting all of your eggs in one basket. One of the best ways to stay truly diversified is to have many different kinds of investments and multiple sources of income. Here's one example of a diversified portfolio. This person, as you can see, has 3 types of real estate. They have their primary residence, they have 2 types of investment properties. One is residential, the other is commercial. This person has various kinds of Wall Street investments and plenty of liquid assets like cash and cash equivalents, which will allow this person to handle emergencies and take advantage of investment opportunities if they do arise. Last, this person has multiple streams of income. They have W-2 wages for work done from an employer, and they have small business income from a business they own, and they also have their real estate income. For most people, the goal of diversification is to have the peace of mind that if something bad happens, they will still be financially okay. All too often, I see individuals who are sold on a fund portfolio and told that they are fully diversified because they have many types of stocks and bonds. This is kind of like how the word investment got stolen by the marketing community, because now if you go to buy something frivolous, like an expensive purse, the salesperson will tell you it's an investment, when of course, we all know that consumer goods are not investments. Brokerages have taken this term and told people that if they buy enough different kinds of funds, they are diversified. But in my opinion, this is not true. If the stock market crashes or the person in my previous example loses their job with their employer, they will still be okay because they have multiple types of investments and multiple sources of income. Or let's try a different scenario. Let's say the person in my previous example has a lot of vacant rental units, or there's a big fire and a lot of their real estate burns down. They still have other investments and other sources of income, so again, they will be okay. More often than not, what I see in real life is that many people have all of their savings and retirement money in the stock market. They only have one source of income and not enough liquid cash. If they lose their job or the stock market crashes, they are not okay. Real estate gurus will tell you that the solution is to put all of your money in real estate. But real estate has its ups and downs too. There is no perfect solution, and I'm not saying that you have to have all of the components in the earlier sample portfolio to be truly diversified. What I want to highlight with this example is that you should think about how your current portfolio can withstand stress or downturns. As a tax attorney, I also look at the diversification of my clients' portfolios with taxes in mind. Each type of asset and income stream is taxed differently. For example, real estate can offer depreciation benefits that can reduce taxable income. Certain investments might qualify for capital gains treatment instead of ordinary income tax rates. And having cash reserves can ensure that you're not forced to sell assets in a down market, which could help you avoid unnecessary or unintended tax consequences. When you combine diversification with smart tax planning, you can minimize your overall tax burden while growing your wealth. At the end of the day, it's about creating a plan that works for you. Whether you're focused on protecting your savings, growing your wealth, or preparing for retirement, diversification paired with thoughtful tax strategy is key. In my practice, I combine my expertise in tax law with financial strategy to create comprehensive financial plans for my clients. To learn more about financial and tax strategy, subscribe to my channel, and I'll see you next time.